Hey everybody, it's me, the Einstein of Wall Street, here from the balcony of the New York Stock Exchange. Oh my God, we are here in the last couple of weeks of this year, and this year has had absolutely everything possible thrown at it, right? 2025 has been an extraordinary year. I've been here for 137 years, so I've seen this movie a million times. Yet what happened this year is sort of unparalleled in so many different ways. Like, you have a market that's basically trading a couple percent off its record highs, yet what's been thrown at this market from the self-fulfilled prophecy of tariffs and the new administration, and that sort of Armageddon that we went through in February, March, and April, and then everything around interest rates and a couple of global wars and a couple of regional banks and all that craziness and madness, topped off by the government shutdown. Market's response to that was not normal at all. The response of the market to the reopening of the government, and then how we're being fueled by this spectacular, this is an industrial revolution, the fourth industrial revolution, quoting Mr. Dan Ives, my mentor, my friend, and who's a master, right? They're one of the great, probably the top tech analysts in the world, in my opinion. And so we're standing here a couple of weeks in, just about to hit Thanksgiving. We've got 5 weeks left, and this market over the last couple of weeks has gone through an insane roller coaster based on a lot of erroneous information that's been coming out. And we know that, look, we're always about one tweet away from crazy town. We know that mainstream media will catastrophize markets and news and breaking news and all that kind of stuff. But I'm bringing you, so look, I'm a humanist. I love to bring you people here who sort of tell a story in a different way. And so I'm bringing Phil Rosen. He's awesome. Welcome, my friend, to Einstein of Wall Street here on the balcony of the New York Stock Exchange. So let's pick it up where we are. Oh, you know what? Let's go back a little bit. So as I just sort of, the entry was about what an extraordinary year we've had.
Of course.
Okay. And as I said, literally everything's been thrown at this market. And up until, maybe 4 or 5 weeks ago when the government shut down, or even in the middle of that, this market still, with all that being said, has been able to maintain 48 record closes this year, even in the eyes of all of this madness. And if we had been sitting here and the market was down a couple thousand points, and it would have been made a lot more sense for this conversation to happen than where we are today. And so, I think it's important to note what's going on. I'm going to pick it up with, so we had the government shutdown, then we had the government reopen. Normally, markets respond negatively to lead into a government shutdown. We did not do that this time. Then they have a positive response to the reopening. We had that, but it was short-lived because of the fact that there was a little bit of gaslighting or gatekeeping around the news and the economic data. See, what's fascinating is never before have we had a government shutdown in the midst of this wild interest rate scenario that we've been living on top of tariffs, on top of the new administration. So this is like a 1,000-piece puzzle, right? We've had 250-piece puzzles, 500-piece, but never have we had this kind of a puzzle with so many different components and so much. Look, even to add a little fire to the story, what's going on between the president and Jay Powell, with Bessent, all that kind of stuff, and the projections of interest rates and whatnot. So anyway, it's so much to digest.
Yes.
Whenever I hear you talk, and I hear you on JD, and I've heard your interviews as well, especially with Dan, right? Dan is, Dan can sort of break things down.
Yeah.
He's amazing. But I just wanted to get your tack on it. I mean, how would you give me a short synopsis of how you see us getting to where we are today?
Yeah, I've heard a lot of people use the phrase, I think even Dan has said it, the most hated bull market. And this has been an unbelievable ride this year because it has pretty much overcome every single bearish headwind. And all you have to look at is where we were in April and where we were today.
Right.
It's like two different worlds.
Yeah.
And the bulls have been right all year.
Yeah.
If you were selling your stocks in April, you missed out on a huge rebound.
Yeah.
And if you know your history, you know that the reflexivity of the bounce was coming. You can kind of anticipate it, even though tariffs, Liberation Day, yes, it was unprecedented. But if you sort of held on to your portfolio, you were doing just fine. And here we are, 2% from record highs. And I anticipate asset prices are going to go much higher into the new year because we're probably going to get a new Fed chair sooner than we think.
Right. And he'll probably surely on the dovish side.
Of
and
course.
He will be following in the footsteps of what Mr. Trump wants him to, even though there's supposed to be a bit of a wall there.
Yeah, and look, I don't know that much about the whole Fed independence debate,
Right.
but I do know if you look purely at the market, it is probably going to go higher when rates come down. And we're not cutting into a recession as well.
Correct.
So that's very bullish for stocks.
Right.
I think the setup looks pretty good for 2026.
Let's talk about the retail investor for a moment, because we know that obviously, look, one of the things, the stories I tell is, I've traded through more crashes than anyone probably who's still trading today. I was not here for the crash of 1929. Anyone who says that, that's erroneous, although that's
fake news.
I've been accused of it. Okay, and so we know that they came in. Look, with the advent of Webull and Robinhood and all that stuff, obviously during COVID, that was a revolution in some way. That was the democratization of the trading community. Everybody suddenly, before that, needed to be an accredited investor. After that, everyone with an iPhone and $100 could suddenly trade the market. Okay, that's fine and good. 50 million plus retail traders came into the market. That's TD Ameritrade's number, and it was legit, probably twice that. Most of them got blown up time and time again around the meme phenomenon. Everyone was sitting at home, sheltered in place, a couple shekels in the bank from their stimulus package, and then GameStop and all that stuff. And so and we do know that a lot of retail traders, at least day traders, are not successful, right? They blow themselves up pretty significantly. But I also track their journey. And what we've seen is, which is a fascinating thing, because you mentioned February, March, April, is that February, March, April, the dip, okay, the sell-off, which we had over an 11-week period from February 19th until April 19th, we were down 20.8%. Surely based on that, on the tariffs and Mr. Trump's way of disseminating information. It was a self-inflicted economic Armageddon, to quote Mr. Ives. Now, all that being said, it was not the retailers who were selling in that dip. It was the big guys. So you just talked about, if you had experience and you were an experienced trader, then you probably should have been holding, you should have seen the cycle that we were in during that time and should have held on to you. And if you were selling in April, then you are regretting that sale. It turns out that a lot of the large institutions and big funds were selling in April, right? They should have not. They've seen this movie before. And it was the retailers, the new retailers who have grown and matured through these markets over the last 5 years, who were actually buying that dip.
Yes, it's been an amazing phenomenon this year because retail's pretty much been the smart money, is what I would say. And a lot of professionals in Wall Street would disagree with that.
I know.
But retail's been on the ball. Yeah, and they pretty much have seen every dip as a buying opportunity, and that has proven right so far. Because again, if you were selling in April, if you were selling these last couple weeks even with the tech sell-off, you haven't been on the right side of history.
Correct.
And a lot of these institutions, they took the tariffs worse than, or they reacted more strong in the negative way than the retail investors. And something I think that also plays into this, which may or may not be a good thing, retail investors generally tilt younger, I would say.
Right.
And with the advent of Robinhood and these social trading apps, the people on these apps, many of them have never seen a real bear market.
Correct.
So that's the one red flag I would point to, because they've been trained to buy the dip all the time because they don't even know what a bear market could do to their psychology, to their portfolio. And, frankly, I'm part of that. I wasn't trading in 2008. I wasn't trading in 2000. So I'm part of that new generation that has really never been through a long-standing bear market. So that's the one concern I have. It's like, if we're trained so much to buy the dip, that doesn't work forever. It's worked very well so far, and the doomers have been wrong. But that's the one thing I'll be watching. So
I love that. I love that response. So let's talk about the last couple of weeks. Okay, so we do know that after the government decided to reopen, that there was a lot of economic data. So we had a government shutdown in the midst of the beginning of a interest rate cutting cycle. Right, because we had already had cut one and part of cut two, right? And so and that's probably never happened before either, where they both happened at the same time.
Unusual times.
Right. Okay. And then you have in the midst of earnings season, you have the earnings season in tech, which has obviously been one of the most robust sectors that's taken us up over the last number of years. You and I could track the meteoric rise of NVIDIA from 2023 at $108, 2024 into 25 going from 108 to 900 to 1200, splitting 10 for 1, post split at $200. We know that. We know that we're in the midst of the big players like the Microsoft and the Google and the Oracle have each put in $600 billion into the projection of data centers and all that stuff. People who are not even in that sector have made that commitment. However, earnings came out in Palantir, and everyone, all these, look, in the old days you used to have Oscar parties watching, right? Now they have earnings parties, right? That's an amazing thing. I kind of love that in a way, as bizarre as it is. I just love the fact that there are more people involved in the stock market. However, Palantir earnings projected great, came out. The stock ran up 7 days into the earnings till November 3rd with the release, literally hitting a record high on the release, and the stock sold off 8%. And it took a little bit of the market down with it. The response, which would have normally, in old school Wall Street, would have been buy the rumor, sell the news. When you run up into the earnings, normally there's profit taking, and it was a completely normal response. However, the response by mainstream was that this, for some bizarre reason, they started to weave a story that this signifies the top of tech, that it's all smoke and mirrors, that AI is not real, it's a bubble, and that, oh my God, the next thing we're going to have to see, the looming and doom and gloom that's on the horizon is NVIDIA's earnings, which were a few weeks away then, and like, oh my God, if that happens again, this market is going to fall off a cliff. Now, they weren't looking at the specifics inside the nuance of markets, because what ended up happening with NVIDIA was it sold off 3 weeks into NVIDIA earnings as people, and it's a way more complicated trade. It was a probably part and parcel to the whole crypto thing and the margin call and all that. I heard you talking about a little bit of that the other day as well. It sold off 3 weeks into that, and then the earnings came out once again stellar, right? I mean, even where they had been weak before, they blew it out of the water, and the stock rallied beautifully. But the fact that that created such a fear in the market that it took the consumer confidence down to a level that had not been seen since February, March, April of last year. Now, like, what do you make of that? I mean, it's so bizarre to even think, how could this, you know, Dan talks about, I was here trading in 95, 98, 2000, right? None of the components of this situation could even any way be correlated to any kind of a bubble. I find that baffling. But everyone went along with it, and that scared the heck out of people, and people dumped the market aggressively.
So when the media comes out and says, all the bubble fears are coming to fruition, which is effectively what we've seen in the last few weeks. That is going to scare people, and that's going to scare the market. The market's going to dump. And again, the people that were optimistic and holding through this were right back to all-time highs. So all of that, this is just part of the, I think, the media environment we have to be trading through, and we have to be able to kind of ignore the noise, because everything that the media is writing generally in these mainstream publications, it's incentivized to get people to click on it.
Correct.
No one's going to click on things that say it's not a bubble. Everyone's going to want to see, why is it a bubble?
So the catastrophism has a purpose.
Yes. So it's, and that's how these businesses are run. That's the model. The incentives are there for clicks. But that's not necessarily the best thing for the market or investors.
Correct.
And really, what I try to write about, I try to look at the fundamentals, the data, I listen to the earnings calls, and that's what I actually write about. I'm not really looking at what these other publications are talking about, because generally they will lean bearish almost probably 100% of the time. They're always bearish. And you know, you could say, I know Ryan Dietrich points to this all the time, when The Economist posts a bearish title on their front magazine, it's probably a buying signal. So I think this is a culmination. We're at the extremes with social media because all these things circulate so rapidly. And look, if you buy into the bubble narrative, then you're going to be sidelining yourself from what could be the greatest bull market we've ever seen.
Correct.
So that's kind of where I stand.
You know, look, if you talk about, you know, Dan uses such wonderful, Dan Ives of Wedbush, one of the great technicians in the space, always talks about, you know, he talks about the bear, and I saw this one thing you did with him. He talks about the bears, you know, as an entity, right? That they're coming out of their hovel, you know, and they're having a Pepsi and a bag of Doritos, and they're, you know, they've gotten beat up. So, you know, I mean, it's like almost looking at Michael Burry closing down his fund. And, you know, and saying that the reason for it, and he's obviously the big short guy, and he said that he's been so out of touch with the market, right? And then that was, I'm not sure what the real reasoning is why he did it, but that he was so out of touch with the market. You know, look, the market's rally can out-sustain anybody's potential to short it. We've known that. That's a historic thing,
Yep.
right? But, look, there's so many fascinating things we could talk about. I interviewed recently Andrew Ross Sorkin.
Oh, yeah.
Right. And,
great book.
Great book, right? And what's amazing about it is that was the one crash. So as I said, I've lived through more crashes and traded through more crashes than anyone who's alive today. And the crash of 29, I was not here for. And it was the only crash that actually was related to stocks. Have you spoken to him since his book came out?
Not since the book came out.
You should, if you want, I'm happy to connect you because it's an amazing story.
I love the book. It was fantastic.
It is amazing. And so he's trying to make some kind of correlation between them then and now. And I didn't see it the way he did, but, relative to a bubble in a lot of ways, because it was the only crash that actually related to stocks per se. So we know that 87 was related to technology and some insurance stuff. We know that 2000 was an internet bubble. We know 07, 08 was a predatory lending situation. We know COVID was COVID, right? And then this past year was all about tariffs. That was a situation where what was similar is it was the historic democratization of the market. So apparently in 27, 28, the market was only traded by the top 1% of the 1%, right? It was very exclusive, not inclusive at all. And then they decided, a couple of guys decided, you know what, let's give the world a chance to invest.
Democratize financial products.
Correct. And so they started coming up with all these products. They gave everybody a chance. If you give me $1, I'll give you $10 back, and then as long as you put it in the market. And then they created a bubble, right? It was like leveraged. Crypto. Apparently, when people buy Bitcoin now, and I don't know if crypto is something you speak about at all, I don't speak about it a lot, but when it affects this market, I think it's worth talking about, that I guess they give out 50 or to 100 to 1 margin on
There's
their
some
purposes.
crazy levels out there.
Right. So and so what ends up happening here is a lot of people who had not gotten in prior to February, March, April bought in around that time. The price then was around where it's trading now. And so apparently over the last couple of weeks, there have been a couple of big bear put bets on crypto. There have been a couple of massive margin calls, and that's also contributed. So when you have a margin call in that, and then you have a big position in tech, right? I mean, think about how, there was a couple of weeks there where they were really pounding NVIDIA. They pounded here, they did all that. And so, I mean, I err on the side of the fact that people have such exposure to tech. It's been their high flyers. Where do I go to get cash if I need it? Well, those names.
So something that's very interesting about everything we're seeing about Bitcoin, people are pointing to how it's down over 12 months. But if you look at like 13 months, it's actually up from 69,000 to 85,000, right, which is a fantastic appreciation over 13 months. And but if you look at the 1-year chart, it tells a little different story, but that's one example of how you can lie with data.
Right.
And it's very common in markets. People do it all the time. The leverage stuff, I've talked to a lot of investors these days. They were pointing to leverage as the reason that crypto sell-off, and as you just said, that seeped into the tech market.
Right.
And again, a lot of this, if you avoid leverage, if you don't buy into the media headlines, you're probably doing just fine. Yeah. And if you just hold your portfolio and you continue your strategy and you stick to it disciplined,
right,
all of this is just noise. And really, that's what I tell my readers. That's what I try to practice in my own life.
Yeah.
Because if you go by what the next business publication is going to say,
right,
they're going to tell you to sell your stocks every other month.
Correct.
And that's not the way to generate long-term wealth.
And look, you can look at history, right? We always say that markets trade a lot of history. We always say, I've seen this movie before, and I've seen lots of these movies before, and it's sort of Dan always also talks about the fact that if nothing significantly has changed in a story, so this is sort of another thing that I'm hoping that people hear this and see us chatting to sort of understand that we're the way we interpret the market is a little different than other people, and we err on the side of a different interpretation, right? And so the fact is that what's fascinating about if nothing is particularly changed, so you'll see very often when one sector or one stock gets sold off, right, and they'll throw the baby out with the bathwater,
yes,
right? And I always look at it, if nothing has significantly changed, if you look at every sell-off going back to 1929. right? And we could number them because there haven't been that many, right? We've had a handful of crashes, a number of pullback, consolidation, sell-offs. Every one of them, net has been a better buying opportunity than a selling opportunity. Okay? I mean, literally.
Wow.
You know, you go back to 24, right? 24 was a spectacular year. The first 3 months were great. April was a pullback. Great buying opportunity. But when April happened, everyone was going, oh my God, it's over, the whole thing, and they blew up. And in fact, NVIDIA actually sold off aggressively then after having a beautiful first quarter. Then you had May, June, July was great once again, and then we obviously had the crash of August 6th. Crash, not a crash.
Yeah.
You know, whatever, the carry trade, all that kind of stuff. Once again, net a buying opportunity. Then we had the sell-off when we did a 50 basis point cut in September, caught everyone by surprise. The market pulled back aggressively, and once again, everyone is going. You know, it's like I always joke when the analogy I use is when you've been seeing this beautiful leather jacket at Macy's that you love. It's $700, and you're just like waiting for a sale to happen, right? And when the sale happens, you don't suddenly go, you know what? I never liked that jacket. It's not actually as nice as it was when it was $700, right? And so people need to understand that mindset that stocks go up, they go down, they go on sale. But if they go on sale, it's not necessarily that anything, no, it can be that something majorly significant changed in the scenario, but very often it's not. And so I think if we can give any advice to young retail investors, or even people who've been around for a while, you know, that if nothing significantly has changed, those are buying opportunities. I mean, opportunity is the name of the game here.
I think that's exactly right. And I think we've seen an amazing example of this in the last 30 days or so. Yeah. We've had Google come out with Gemini,
right,
and we've had reports that Meta wants to start using Google chips.
Right.
And that's pushed NVIDIA stock down. NVIDIA's down about 10% in the last month.
Right.
Google's up, I think, 20% in the last month. So you have this K-shaped divergence.
Okay, stop. I got to interrupt you.
Okay.
I heard you say this stuff last night.
Okay.
I don't know. Explain to me the Gemini thing with Google, because I don't know that whole story, and explain to me what a K-shaped thing is.
So right now, the K-shape is just a divergence into outcomes or scenarios, and it's most commonly used in the K-shaped economy. You have high-income households that have done very well because they're owning assets, owning stocks, and it's been a great year for them.
Right.
Whereas lower-income households have done less well. Things are expensive. There's still inflation.
Right.
Consumer sentiment is down. So you have the K-shaped divergence there.
So it's like it's like that. I understood. I got that. Okay.
So it's not an exact analogy, but I'm using it for NVIDIA and Google.
Okay.
And I think it's.
Well, explain to me about it, Gemini. So what?
Gemini.
Google came out with
an unbelievable new AI model.
Okay.
It is mind-blowing, and I would highly encourage everyone to test it out, play with it, learn how to use it.
It's a ChatGPT thing?
ChatGPT, but it has image, video, it has charts you can do.
I heard you describe it. It sounds incredible.
It is unbelievable.
Okay.
I'll show you later. That has led a lot of people in recent weeks to say, okay, Google is the new king of AI. It's winning the AI race. And I think maybe that's true. I have no idea.
Okay.
But if AI turns out to be the technological revolution we expect it to be, or at least the optimists expect it to be, we're not going to be talking about Google and NVIDIA going in different directions.
Right.
They're both going to be top of the world,
right,
dominant, amazing companies and amazing technologies. So I think the divergence we've seen between Google and NVIDIA the last month, I think that's sort of a mispriced moment in the market, and potentially, I think, a buying opportunity for NVIDIA, because when NVIDIA is going down, you know that they're going to crush their earnings for the next several quarters.
Yep.
So if you liked NVIDIA 10% ago, you should like it even more now.
100%.
And I think this AI divergence story between Google and NVIDIA, this is exactly what you're talking about when the fundamentals or the story doesn't really change, but the price starts moving dramatically in one direction. I think that's an opportunity.
So that's amazing too, because look, at the end of the day, we're seeing what differentiates this revolution from so many others is companies that are not even in the AI sector or that techie are realizing that this is a runaway train on this industrial revolution, and they're throwing money at it, right? And so they're doing it. You're leaving like a Meta or a Google or an Oracle. We know that last $100 that Oracle rallied after its earnings was more about the commitment to putting $600 billion in for data centers 5 years out than the fact that they had good earnings, right? And we saw that confirmed by the fact that when this whole AI bubble thing came along, it literally went down $100.
Yep.
It gave back all of that. It was almost so specific, it was kind of nutty. But when you've got companies that are, so when you have something that's a revolution, it's not just sector bound. It's going to affect everybody. And if these big companies were not to sit around and participate, if they were to say to their shareholders, you know what, guys, I would rather give you really, really great earnings, even though they have had good earnings, and not, because one of the other things that sort of popped up was a lot of these companies are actually taking on debt by committing so much money to AI when AI is not their wheelhouse, right? But my gut is that they're looking at this runaway train going, you know what, I would rather have maybe a few upset investors who I need to explain to them, you know what, you don't want me to come to you 5 years down the road when it's trading 10, 20, 100x and go, you know what, I didn't want to take a risk. These are visionaries. The guys who run those companies, like Jensen, like Zuckerberg, those guys who are those guys are visionaries. They didn't get to where they were by being conservative in investment, in making moves and all that kind of stuff. So they have to look to the future. They have to take chances. And that's a lot what's going on.
I think it's really difficult to try to price the future. Like, we don't really know what the future will bring, especially when it comes to innovative and new technologies, because almost by definition, we can't conceive of it today. Right? So how could we possibly use some type of financial valuation model or metric to tell us how much this company is worth if we can't even imagine, the majority of people can't even imagine what they're building. So to me, it's like, look, we are probably still in the very early days of this, and I don't even think we've seen the productivity gains people are talking about. I think that's been a drop in the bucket so far. I think on an individual...
The second inning of a 9-inning game.
As Dan says, of course. And if I look at my own life, I feel more productive from AI, but I know a lot of people aren't fully using it yet. I have a lot of friends that barely touch it.
I've actually never even.
I'll show you sometime, Peter. No worries.
I've never even hit whatever. Okay.
It's so exactly, and imagine how many people have not touched it yet. The point that it becomes so pervasive that it's like drinking water. That's when we'll see, I think, sort of the productivity gains people are already talking about. That's when we'll see the real effects of it. And companies already point to it as reasons for layoffs. I think it's kind of a excuse for layoffs. But eventually, I do think we will be able to do more with less people, and that's going to be seen in every single company.
Awesome. All right, so to wrap it up, look, we should do this more often.
Totally.
It's really fun. Just give me, so we've got 5 weeks left in the year, right? Your scenario for end of year, your projection for end of year.
I don't like number projections, but I do think we're going higher, because I think we're going to get a rate cut in December. We're going to get a new Fed chair, which is going to price in more rate cuts than we think. So those two things will drive asset prices higher. And then I also think generally, as you said, the story has not changed for the AI movement, the AI revolution. Those things are still in place, and you're getting rate cut momentum. I think we're going higher.
Beautiful. You know what? It's really been a pleasure. I would love to do this again. Ladies and gentlemen, we just gave you a really exciting breakdown on where, coming out of a few weeks where there was more anxiety, we had the VIX go up 10, 15%, 3 days in a row. Finally, the fear is coming out of the market. The market's more on a path. The runway seems sort of clearer, and Phil has obviously given us a nice breakdown on what makes a lot more sense than the story that's been weaved, and the table's been set for a really positive end of year. And so I look forward to it. My pleasure, sir.
Thank you, Peter.
You know what I got? That's all I got for you, the Einstein of Wall Street. I'm out of here.